Welcome to another vlog here on Wolf of Dubai, your stock investing channel on the internet free of charge for you every single day. So today we are talking about passive income, and if you are not subscribed yet, make sure to do it right now. So we will talk about passive income on the stock market. Is it really passive, or you have to become active first? Let's roll and see in this vlog.
Wolf of Dubai.
Now you must think that, passive income is one of the biggest keywords for millennials and other people who are looking to get rich or improve their life standards. And that's true, because you have most of the people out there have one stream of income, which is the salary. So on the one hand side, it's the easiest way to go, right? You offer your time against some salary, and you basically deliver months and then you get paid. So you're working on, let's say, 30-day of invoice, and you give someone a service, and as more value this service brings to a company, the more the company pays you. Okay, so and this is the easiest way. We go to school, we go to college, because as more knowledge we have, as more value we can bring to the company. So this is one source of income. But what happens if the company fails? What happens if you get sick? What happens if the market changes and the people need some other value services from other kind of people, and so on and so forth? So this one source of income is very, very risky, and that's why you should look into other ways. There's multiple source of income that you can create. And passive income stream is very interesting because you can, work and get your salary, and beside that you can create 2-3 other streams of revenue while not being working every day and active on this source of income. And actually the definition of passive income is as follows. So passive income is when you continue to get paid after the work is done. This includes royalties from books, movies, songs, and also revenue that comes from real estate, investments, or business investments where you don't have to be present to earn it. So that means that you obviously have to put work on it first, or put investment down first, or put ideas or time in it first, and then get paid, but don't have to be there at present all the time like you do in your main source of income, right? So actually this is quite interesting, because you can do it with real estate and with the stock market, with a business, and today we are concentrating on our niche here on this channel on the stock market. So how and why and how to get started to get a second income with your savings, with investment on the stock market, and not getting away from the thinking that you can lose everything and it's very, very risky and so on. So we will talk about all these topics here in the vlog, so make sure to stay until the end. And before we dive in, make sure to smash that like button for me, and let's go into the first category, which will be owning a stock. Okay, so first of all, we have to understand why owning a stock and what does it mean to own a stock. All right, so with owning a stock, you own a piece of company. So actually you are getting a piece of their IP, their intellectual property. You get a piece of their profits, you get a piece of their real estate, right, where they building some kind of products. You get a piece of their talents, and so on and so forth. So actually you are trusting that this tiny piece of property, your piece of company, will be worth more in the future. All right, so actually the stock market is open 5 days a week, and 5 days a week, the money that you put in can work for you. So actually you have to just put obviously time into it to find, okay, this property, or this stocks have to have future, you know, the market is growing, they do well, they have a very well established business and so on, and then invest into those and then go further and sell this stock to someone else for a higher price. And this is how you can make, you know, passive income, because you don't have to work for this company by going there every day. So you just own a small piece, and the small piece gets more worth over time, hopefully, and that's why you can choose to own a stock and a small piece of this company. Now let's go into it, how stocks pay you passive income, right? So let's say you own this piece of company. The first obvious reason how the stock can give you worth is actually by getting more in value. So this can have a couple of reasons, right? So the company can get really good numbers, they sell the product, they are good established in the market grows for them, right? Maybe they stay on the same market share, but the market grows, right? They are very good in designing products. They maybe have a really good investment team. They have maybe really good, you know, property asset portfolio that brings the company further and pays the company dividend on their investment. And it's like an investment inception, right? Because you are owning a piece of the of the company, that owning some properties can be intellectual property or can be real estate property, which pays them dividend, right? So there's a couple of ways that the company can go worth more, and in the end, you know, maybe the company, you have invested $10,000 and then the company grows, the market company value grows 10% during a year. This makes 10%, so $1,000 on this $10,000 for you as a profit, you know, while doing nothing and not working actively for the company. This is number one. The second option how you can get paid on the stock market is dividend. So imagine, while owning a fraction of a company, you can actually get a piece of their profit as well, because some companies offer to pay a bit of their profit back to the people that trust the company and invested money in them, and to make that profit possible, right? So it's a logical step for a company to say, you know what, a part of our profit goes back to our investors that trusted us, you know, and we love them and we pay them every year. You know, a company can decide they pay it every quarter, and you get like a cash, you know, so you have the stock and you get cash on top of that from the company that you're owning their stock. So this is somewhere between 2 and 7%, depending, you know, how good is the company, you know, how is the stock price going on. As more the stock price go down, the portion considered to the stock price is getting bigger, so you get bigger percentual dividend. But also it's also can be the other way around, the stock goes up and the dividend portion gets smaller percentage wise on the stock price. Now the beauty of it is, let's say you invested in a stock that don't move at all, so you still get, let's say, 2 to 5% dividend on your money. So in the end of the year you still have passive income in forms of dividend. You know, so it's quite interesting as well. Some people do only dividend investing and choose companies they only pay because they say, you know, if the market overall goes up, the stocks maybe stay the same or go up. And, you know, with this dividend, the beauty out of it is that you can reinvest it and buy more shares to get more dividend, and you understand the way which the possibility that can reach very, very high levels. So this is quite interesting with dividend investing. Now let's talk about the quick argument that you have right now in front of the screen. You say, Danny, you know what, that's brilliant explanation, and how you present it is the most beautiful YouTube video I have ever seen, but what if I'm not lucky and choose a stock that goes down and I lose all my money? Now that's a very, very, very good argument, subscriber. If you are not a subscriber, make sure to subscribe right now so you get counted as subscriber as well. So however, There's other ways to be, let's say, more broad and invest in the market while having a lower risk, because you are totally right. You are such a smart person out there. You are watching this channel and just getting smarter every day. So I understand how smart you are there just in front of the screen. But make sure that continue watching this channel to get even more smart. Now, jokes by side, let's say you have the great argument. Now there's a couple of options that you say, you are invest in the bundle of stocks, because if you invest in 10 stocks at the same time, the percentage is that maybe 8 stocks do very well and 2 stocks don't do well, and still you make profit because the more stocks do well, the whole portfolio goes well. Now you're thinking, okay, how I choose this 10 stocks? It's always gamble, but there's a couple of, let's say, good reasons to choose an index. This is how we call this bundle of stock, that historically speaking, over the last 40-50 years, they never lost money. And we had the world wars, we had financial crisis, and so on. So on average, over the last years, the stock market always returned about 8%. And this is true, for example, for the S&P 500. This is the Standard & Poor 500 index that contains 500 of the best US companies out there. And if you are betting, for example, that you think, okay, the US economy is number 1 in the world and will continue to grow, and if the economy crashes, then we have a totally different global problem. And maybe you are right, and this is how most of the people are thinking. So you can invest into this index with 500 companies, and this, historically speaking, telling you all the incidents that we had globally and politically, always won money in the end. So this is number 1. And there are thousands of different indexes. You can say, okay, I'm more into electric vehicles. There are indexes for electric vehicle that have the top 20 companies, suppliers, research companies for electric vehicle. There are, if you more into the German industry, you going for the DAX, the German index of, I think, 30 companies, right? And there are different kind of indexes, consumer indexes, and so on and so forth. So you get the point. So you can invest in this index. You can also invest into dividend strong indexes, and so on and so forth, to make it very, very low risk. And I believe it's even lower risk in the end than buying a property, because you can pay out your money almost immediately. Second, when you buy a property, you invest in a specific area, in a specific street, for a specific house, right? So let's say there's something happening in this area, politically, neighborhood, criminality, weather, right? So what happened with your property, So there's a couple of, risk as well. So property is not, the low risk thing ever, and try to sell a property when it's already too late. Within a second, it takes months to sell a property, or weeks, depending on the market, obviously. So stocks is a very interesting investment vehicle. Let's talk about a little bit why you should not leave your money on your bank saving account. Now, let's talk about inflation. Inflation is actually the economical mechanism that money with time gets less value. So that's a fact. This is something you cannot change, all right? And typically it's around 2%. So let's say you have $10,000 on your bank saving account, right? And you keep it there for 1 year, right? And now you say, okay, this 2%, I don't see it. I still have $10,000. So actually, if over time, if you go to a store and would love to, buy an item for $10,000, actually, if you go 1 year later and want to buy the same product or the groups of product, you will see that, the prices should be somewhere about 2% more than last year. So actually, you are having the same amount on your bank account, but you can buy less product for the same money. Now, this is sometimes very, very hard to get into you, like psychologically, because it's not like from the 31st of December and then 2% more on the 1st. No, it's like slowly going, you know, like for example, a house could cost like 20 years back like $10,000 and now it's $100,000, you know. With time it goes more. Or let's say your salary of your grandma was $2,000 back then and now it's like say $5,000, you know. So you get the point. So that's why you never should have your money on the saving account, except you get 2%, you know. This is like the minimum. You should definitely look into that. But nowadays it's really hard to get money, as you know, the economy want you to spend money, so they don't offer big percentage on your money. And that's why it's important to invest your money, that your money pays you and not other way around. So let's jump into the final conclusion. Okay, so if you are here, first of all, I appreciate that you watched this video, because this is not only nice for me as a content creator, but also for you, to make you a better investor and to let your money work. And if you are going away from this video and taking something out of value within this 10-15 minutes spent, then make sure to remember one single thing: let the money work for you, not other way around. So the money have to flow, the money have to be invested to pay you back and to, you know, to regenerate itself, right? To get a couple of interest for you and so on. So don't let money just be in the bank account, in the mattress or whatsoever. So the second thing I want you to remember is that the stock market income, passive income, if you want to keep it like that, is just one additional channel. And maybe you should, you know, have 5 or 6, you know. So you have your job, you have your property, you have your stocks, you have your maybe small business, small online business. Today it's so easy to open a new online business, you know. You just need basically your phone and a bit of time and so on, and maybe additional small other businesses that you invested in and so on, and maybe a saving accounts that pay you money. So have a couple of additional multiple streams of passive income, because this over time will get you rich. This is guaranteed, and it's lowering your risk if something happened with your main job or other multiple income streams that you still have. Let's say a couple of other streams that keep you afloat, keep you making money and so on. As more money these streams bring in, and you reinvest it, at more money it brings and so on. And maybe in 10 years, 15 years, you don't have to work anymore, right? So it would be fantastic to do that. So, and another and last one, what I really want you to take from this vlog is that you have to be active first, right? There's nobody that say, you know, I will do that for you. It takes some time, it takes some courage to do that. I totally believe that. I was there, you know. So make sure to do it. If you are 18, start immediately. If you are 45, start immediately, because it's never too early, but it's always too late. So make sure to make this as soon as possible. Try to let your money work. Not even, you don't have to put everything on one horse or on one basket. You can put it into different sources. If you have, let's say, $5 saved up, put $1,000 in the stock market or in the index, and maybe put $1,000 in a small property, or save up to a property as down payment, $1,000 into a saving accounts that pay you money and so on. So split your risk always depending on your cash capital, obviously. And I wish you all the best. Thank you for watching, and see you tomorrow, because I am vlogging every day. See you tomorrow. Thank you very much for watching.